Coming up on Market to Market, USDA releases its first production estimate on this year's crops. The battle continues over a proposal to build the Keystone XL Pipeline. And we'll spend some time with author and agricultural consultant Temple Grandin. Those stories and market analysis with Walt, Hackney, and Virgil next.
Funding for Market to Market is provided by DuPont Pioneer, working with growers to match the right product to the right acre. Science with service, delivering success. This is the Friday, May 10 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Mike Pearson. Crude oil prices declined by more than 2% in early trading Friday as the U.S. dollar posted significant gains against foreign currencies and OPEC announced rising production in April. Benchmark crude for June delivery fell 2.7% in morning trading on the New York Mercantile Exchange. Since oil is traded in dollars, a stronger greenback makes crude and other commodities more expensive for investors with other currencies. The dollar also pressured the euro this week and broke above 100 yen for the first time in 4 years. Meanwhile, OPEC announced its crude production gushed to a 5-month high in April of 30.5 million barrels per day. But the U.S. average price for a gallon of gasoline rose a penny on Friday to $3.56. That's about 4 cents higher than a week ago, but it's also 18 cents lower than in May of 2012. OPEC noted Friday that global crude supplies increased 450,000 barrels per day last month as production from non-OPEC nations like the U.S. and Canada also rose. And against that backdrop, the battle continued this week over a controversial pipeline to build the Keystone XL Pipeline.
If I could say, okay, go ahead and put this pipeline through, but oh, by the way, could you keep 75 or 80% of that refined product in the United States? That would be no, because they want to export it.
The waiting game is far from dull where the Keystone XL Pipeline is concerned. Though the door has closed on the public comment period in response to the U.S. State Department's environmental impact statement, another has opened. For several years, TransCanada Corporation has sought a U.S. presidential permit to deliver oil sands crude from Canada to refineries in the Gulf of Mexico. But American landowners, national environmental groups, and grassroots opposition have opposed the plan every step of the way.
This is some of the soil that are our natural resources that we don't want to be contaminated.
TransCanada claims the $5.3 billion project will require 9,000 skilled American workers to construct portions of the 1,100-mile pipeline. Though assembly of the conduit is already underway in some states, the Nebraska portion has met the most resistance. Because of the route's proximity to environmentally sensitive areas, many voices in the Cornhusker State have come together to be heard.
What the hell is the matter here? We are being asked to accept a pipeline and jeopardize our environment for a measly 35 permanent jobs. The generations that lived here and worked this land have created more economic growth and more jobs than this pipeline ever will.
While Nebraska's leadership approved a revised route early this year, opponents held out hope that President Obama would reject TransCanada's request. But a March report by the State Department, involved because the route crosses the border with Canada, found no significant impact to Nebraska's environmental resources. Those for and against the pipeline were on hand in Grand Island, Nebraska last month to voice their opinions of the State Department's environmental analysis.
Right now, trains carrying bitumen from the Canadian oil sands are headed to the Gulf Coast. Keystone XL should take many of those barrels off of rails and onto pipelines, which again are the safest method of transporting them.
On the final day of the public comment period, the Environmental Protection Agency weighed in, calling the State Department's findings insufficient. Under the National Environmental Policy Act, EPA could promote the interagency dispute to the White House Council on Environmental Quality, setting the stage for even more legal wrangling. For its part, Congress has been working on legislation to circumvent the president's authority and push forth efforts to greenlight the project. In a memo to Republican congressmen last week, House Majority Leader Eric Cantor outlined a May legislative agenda which pushes forth the Northern Route Approval Act. Cantor said the bill would ensure the pipeline is built without any further delay.
There are 3 pipelines in Nebraska have gone across the aquifer and have done so for over 50 years, and they've done so safely. I mean, when you start thinking through the logistics of that argument, of having an export pipeline that's going through the Gulf of Mexico, it doesn't make economic sense. It doesn't pass the common sense smell test.
Yeah, there's thousands of pipelines across Nebraska, I realize that. But you know, life's all about change, and we have to change the way we're doing things.
Drought and other factors took a heavy toll on the livestock industry last year, according to a new study from South Dakota State University Extension. According to SDSU's Center for Farm and Ranch Business Management, high feed prices dramatically reduced profitability in 2012, particularly in the dairy sector. According to the study, the average South Dakota dairy producer endured losses of $398 per cow in 2012 after enjoying profits of $707 per head in 2011. Cow-calf operators fared better, but still reported an average loss of $27 per head last year, compared to gains of $88 per head in 2011. So far, 2013 isn't looking much better. And as fate would have it, feed costs are rising now, not because of drought, but because conditions are too wet for farmers to plant. As livestock producers cope with financial losses, it may seem odd to consider the conditions endured by the animals. But that's exactly what made one scientist a household name in livestock circles. And for Temple Grandin, paying attention to the details pays dividends for producers, processors, and consumers. David Miller explains.
Equipment I've designed back in the 70s and 80s when I first started handling of cattle at the slaughter plants, and I'm not going to call them harvest facilities. That's PRBS. I'm just not going to call them that. Just BS. And when I went to Hollywood, I used the slaughter word, and it was just fine. And they were very curious about what was going on.
Dr. Temple Grandin, author, feedlot designer, industry consultant, and animal scientist, is speaking to a gathering of farmers at an annual Iowa Farm Bureau meeting. Grandin arguably is one of the most outspoken and influential leaders in the industry. The results of her work are evident from the feedlot gate to the packing plant stun line.
You know, we got to open up the mystery sheds.
For nearly 4 decades, Grandin has worked to increase awareness of how proper animal handling in the feedlot and at the packing plant is good for animals as well as the bottom line. She has combined innovative facility design, lectures, and hands-on classroom work to achieve her goals of efficient and humane treatment of animals. But achieving that goal was anything but easy.
Breaking into a man's world was really difficult, but there were some enlightened, good people in the industry, and they were some of the people that hired me. Actually, I found selling the design actually was quite easy. The thing that was hard was getting people to not beat up the cattle. Oh, the handling of cattle in the 70s was so awful. I would work with places and we'd put in new facilities, and they'd do atrocious things to the cattle in the new facility. You know, people would buy the thing, but they wouldn't operate it right.
Grandin's designs protect animal and handler while reducing stress for both. In the feedlot, her curved chute design takes advantage of the tendency for cattle to circle back to where they started. Races are just wide enough for one animal to easily walk towards a squeeze chute, and one-way backstops prevent any attempts at retreat. Elevated walkways and trap doors give employees escape routes. At the packing plant, holding pens have angled sides instead of square corners, and alleyways have non-slip surfaces. As animals approach the stun line, they are herded into a long serpentine chute. The curved walkway relaxes the cattle and allows them to follow each other, nose to tail. When the animals approach the stun box, they are supported by a center track restrainer system designed by Grandin. The restrainer helps keep the animals calm and prevents them from falling to the ground after stunning, making them easier for packing plant employees to handle. Her research and real-world results have proven the animals are easier to handle and produce a better product.
Now today, we got a lot more interest in good handling. And I worked with McDonald's Corporation back in 1999 on implementing animal welfare auditing. And when I did that, I saw lots of change happen, because now the plants had to do it if they wanted to stay on the approved supplier list.
To stay on the list, suppliers had to pass Grandin's animal welfare audit with high marks. That meant 95% of the animals had to be stunned on the first attempt. No more than 1% could fall on the way to the stun line. No more than 3% could be mooing or bellowing. And 75% had to move through the line without the use of an electric prod. Grandin has autism, and she has devoted a good portion of her life to helping others with the same affliction. She tells people with autism to avoid thinking that their disability comes first, but instead to identify themselves as a person who has unique qualities that happens to have autism. Grandin will be the first to tell you that because of her autism, she thinks in pictures.
When I was very young, I thought that everybody thought in pictures. I didn't know that my thinking was different. I didn't know that other people thought more verbally. So the very first work I did with cattle was to get down into the chutes to see all the stuff that the cattle were seeing, like shadows, reflections on puddles, a coat on a fence, a vehicle parked next to the fence. And I noticed that these things would make the cattle balk. And nobody had noticed it before. But since I thought in pictures, it seemed obvious to look at what the cattle were seeing.
Her direct, off-the-cuff style has earned accolades from a wide range of groups who rarely agree on anything. They range from the American Meat Institute to PETA. Grandin believes the veil needs to come off the meat industry, and she is adamantly opposed to ag-gag laws that make it a crime to shoot undercover video at packing plants or on farms.
I think that ag-gag bills are the stupidest thing the ag ever did. Because when that hit the editorial page of the New York Times, and I was in New York the time that happened, that just looked like cover up, cover up, cover up. You know, when you get bashed, you need to be opening the door, not shutting it.
In the interest of transparency, Grandin is working with the American Meat Institute to take the mystery out of what happens inside a packing plant.
Internal organs are removed.
Bill Kauser owns the 5,200-head Kauser Cattle Company located near Nevada, Iowa. The design of his feedlot was inspired by a lecture Grandin gave almost 25 years ago.
After seeing her speech that many years ago, we came back home and went to work because now we understood why animals weren't moving correctly and why we were seeing the stress.
Recently, Kauser built a handling facility based on Grandin's design. He considers the $500,000 investment well worth the money.
I've seen a dramatic change in my employees, especially my feedlot manager. It used to be when we would get multiple loads of cattle in, you kind of tried to put it off a little bit. It wasn't something that you looked forward to. Today, it's nothing to come in here and process them. And they also know that they're no longer standing in harm's way.
In December of 2012, Kauser got to meet with Grandin and express his gratitude.
You know, it was such an experience, a thrill and an honor to sit this close to a woman that has meant so much to all of us in this industry, livestock industry. And when she says something, I mean, you're just writing it down in your brain as you go, because it's almost gospel when you're listening to her, because you believe what she says.
Grandin's work goes beyond being a spokesperson for low-stress animal handling. Since 1990, she has been a professor of animal science at Colorado State University in Fort Collins, Colorado. For more than 2 decades, she has taught a short course on feedlot design, animal handling, and general problem solving. Many among this next generation of ranchers, feedlot owners, and veterinarians travel long distances just to learn from Grandin. Pleased to no longer be a lone crusader, Grandin believes there are several reasons why it is easier for her to get the average person to listen to her message.
And I think some of this is big customers demanding it. Because I've had a saying I've had for a long time, heat softens steel. And then reformers like me can bend it into pretty grill work. And the thing is, I want to bend it into pretty grill work, not just have a mess. We've got to do practical things that are going to work.
Next, the Market to Market Report.
Grain prices tumbled this week as the combination of a stronger dollar and bearish supply and demand reports dampened prices. For the week, July wheat lost 17 cents, while the nearby corn contract moved more than 25 cents lower. Old crop soybeans bucked the bearish trend as the July contract posted a weekly gain of 12 cents. Nearby meal prices traded sideways with an upward weekly move of 30 cents per ton. In the softs, cotton eked out a weekly gain of a nickel per hundredweight. In the dairy market, June Class 3 milk lost 21 cents, while the July contract moved 15 cents lower. Over in livestock, the June cattle contract lost $1.37. August feeders were off nearly $1, and the June lean hog contract declined by $1.67. In the financials, the euro lost 127 basis points against the dollar. Crude oil gained 43 cents per barrel. COMEX gold declined by $27.50 per ounce, and the Goldman Sachs Commodity Index moved fractionally lower to settle at 630.30. Here now to lend us their insight on these and other trends are two of our regular market analysts, Walt Hackney and Virgil Robinson. Gentlemen, welcome back.
Thank you, Mike.
Virgil, I'd like to start with you. We did have the supply and demand estimates from USDA out today, and I'd like for you to talk to us a little bit about what happened. The numbers roughly reflected trade estimates. How are these estimates going to impact wheat production and producers going forward?
The U.S. wheat production was actually forecast to decline year over year, Mike. However, globally, that's not the case. Increases in major exporting countries, the likes of Canada, Australia, Argentina, and others, more than compensated for the loss or the reduced production here. Hard red winter wheat is an interesting study in my mind. Production is forecast to decline year over year. Condition reports, at least initially, indicate the sum of good and excellent wheat through the Southwest to be as one of the lower levels of many years. So I think the theme there will be probably an unusually strong basis all year long, Walt, in an effort to try and source fewer bushels of higher protein wheat as well as less carry. Globally, however, wheat supplies will be ample, and it is likely that global prices will decline, Mike, over the next several months.
So this does put U.S. wheat producers in a bit of a tough spot when you're looking at the lower production estimates that we're faced with in the country versus increased global supply. What's your best advice to producers out there in terms of trying to make a profit in this market?
Well, I hope they've done some selling or forward contracting or some type of price risk management prior to tonight, Mike. In the event they have not, there'll yet be, in my mind, some weather-instilled rallies, at which point they'll be given the opportunity and the opportunity to make a decision on price. And I'd use those, Mike, to price physical product or certainly at a minimum create some kind of price floor below that production.
At least be able to ensure some margin as the season progresses.
Yeah, I think that's right. And again, oftentimes, and we've seen that this year in both corn and soybeans, the strength in the market is really a manifestation of the local basis and lack of carry. And that certainly is the case in several commodities tonight.
And it's certainly true in corn. Could you talk to us a little bit about the USDA's estimates in corn and what effect that's going to have going forward?
Yeah, the theme was pretty well established back in February regarding year over year, or the increase in year over year supplies here in the U.S. as well as in the world. So I don't think that comes as a big surprise. I think we mentioned, Mike, last time we visited, that this is one of those years, if you accept the recent S&D at face value, where storage hedges, having on-farm storage, the wherewithal to make a short hedge, then capture the carry, normally in the fall of the year, and then look for basis levels to appreciate in the spring of 2014, there'll be some attractive storage hedge opportunities in corn. I think will improve price well beyond what corn is worth tonight for fall delivery. So that's an opportunity.
It's an opportunity. And for folks with old crop production still in bins, what does the situation look like there? We're going to see tight supplies all summer.
There'll be a point in the calendar where we make the transition from the assumed or the legitimate tight stocks to much more adequate supply. At what point in the calendar, I can't tell you, Mike. Much will depend on how we plant the balance of this corn crop. we're not likely to have the kind of supply we had last year as early as we did. So certainly that is a factor. For those that still own old crop corn, tributary, I think, to ethanol facilities, tributary to feedlots, tributary to rail shippers, I think they probably should continue to look for opportunities at price levels above tonight's market.
Okay, let's take a look at beans. We've, again, nothing too exciting in the report that came out today. What does that tell you? What is the market interpreting from the report today?
Well, again, much like the February forum, the theme here is in a year's time, we swing from unusually tight stocks of soybeans in the U.S. to what is projected to be more comfortable supplies. That was, I think, accentuated by the fact that global supplies are forecast to increase significantly season over season. So please understand and acknowledge that as you think about your new crop, should you have little or nothing priced. At face value, tonight's supply and demand estimates are bearish for new crop corn, new crop beans.
All right. Well, thank you, Virgil. Appreciate your thoughts there. Now, I'd like to talk to Walt a little bit. Building on what Virgil's talked about, we're in a very interesting time in the cattle market, particularly in the live cattle market. I was hoping you could sort of shed some light on what packers and producers are experiencing when we're seeing record retail prices for beef cuts and high cash prices, but we're not seeing it on the board. Could you give us a little bit of an insight into this market?
There's so many factors, Mike, that are influencing this beef livestock trade as we speak. And you hit on the majority of those factors. Why would the mercantile be sitting there as we speak, varying by the month we're in reference, but from $3 to $5 or $6 a hundredweight under the cash market? That's a kind of a new occasion for a lot of the traders. The other occasion we have is last week we sold fat cattle from Colorado through the Corn Belt, particularly the Northern Plains, at $1.31. We sold those same cattle out of the West Texas, Kansas, and Oklahoma country at $1.28.9, which isn't uncalled for. The fact remains, dressed beef was more or less a sideways affair. It didn't really, in the cutout values, do much price variation during that up of $4 to $6 a hundredweight in the value of the cattle last week. This week we've lost from $4 to $5 a hundredweight in the price of our feedlot cattle. We've gone from $1.31 to $1.26. We have gone from a dressed price of last week of $2.07 to $1.98 to $2 this week. We have, in the value of the choice beef cutout, went to all-time historic highs this week, an appreciation of a little over $4 a hundredweight. These are all questions to be answered. The industry, as we speak, Mike, is in more of an undecision type of a position than I personally have ever seen it. There is no real definition to the questions that are coming out of this price market. We've got packers short in their kill this week, particularly with the rise in the dressed beef market. They're not in the market to buy out of necessity, or if you will, a forced affair. They're sitting there bidding steady money at lower prices, expecting that sometime today, as we speak, they will in fact own cattle instead of $1.28, where some of the cattle are being priced there. They'll be able to own them at $1.25 or $6. And they're trying to wait out the cattle feeder. the shortest inventory of finished cattle we've had in years. Yet they feel comfortable in waiting it out and being able to dictate where the price of this product is. Where is the profits? No one will want to put a figure on it, but retail has got some phenomenal profit in their market, in their structure. Packers have got a decent profit. For a moment a week ago, the cattle feeder had a glimpse of a profit. This week, we're right back to the 150 to 200 plus loss in the fat cattle.
So we saw fat cattle producers see a little bit of black ink last week. What are you seeing on the feeder side? What are feeder cattle producers seeing?
Well, you've still got a historic shortage of feeder cattle availability nationally because we've got the lightest number of beef cow herd in the nation. We've got the lightest number we've had for over 60 years. We've got availability of summer cattle to go to grass is nearly impossible to get out and find the adequate numbers the ranchers are wanting.
Well, we've got to go real quick to your thoughts on lean hogs. What is your take there?
I think the lean hog market versus some of the commentary, I think the lean hog market is due to see an increase in availability of market hogs back to 2,200,000 head a week compared to some of the projections under 2 million head due to price of corn, as Virgil has discussed, and all of that. Feed costs and losses are astronomical in the hog industry.
All right, tough situation. Thank you very much, gentlemen. Really appreciate you being here with us tonight. That wraps up this edition of Market to Market. But if you'd like more information from Walt and Virgil on where these markets just may be headed, visit the Market Plus page at our website. You'll find expanded market analysis, audio podcasts, and streaming video of our program, as well as links to our Twitter feed and Facebook account, all free at the Market to Market website. Be sure to join us again next week when we'll examine efforts to maximize yield through effective nutrient management. So until next time, thanks for watching. I'm Mike Pearson. Have a great week.
Market to Market is a production of Iowa Public Television, which is solely responsible for its content. Funding for Market to Market is provided by DuPont Pioneer, working with growers to match the right product to the right acre. Science with service, delivering success.